We're going to look at the sale and leaseback of that office building. You can read this if you want to illustrate how we might evaluate the decision to sell and lease back space. Let's extend this previous example. Suppose 5 years ago the corporation chose ownership over leasing. Fast forward, management is contemplating a sell and lease back. Property could fetch $2 million if sold today, with a leaseback rate of $200,000 per year over a 15-year term. Considering that the property was purchased 5 years ago for $1.8 million and has depreciated since, the firm would incur a capital gains tax of $135,000, leaving an after-tax cash flow of $1.865 million from the sale. By opting to lease rather than own for the next 15 years, management would face an additional annual outflow of $155,000 in after-tax cash. Furthermore, if the property sold now, the firm would miss out on the cash flow from a potential $3 million sale at the lease end. As shown in Table 16.5, the internal rate of return from continuing to own versus leasing stands at 14.10%. This can be seen as the return from persisting with ownership or as the cost of the sale-lease arrangement. Essentially, the price of obtaining $496,000 upfront by selling then leasing back the property. This return from ownership slightly surpasses the original leasing scenario, bolstering the case for retention. Additionally, higher lease payments resulting from market rent increases over the past 5 years enhance the benefits of ownership, as this elevated lease payment are now avoided. Opting to lease would mean higher payments offset the increased property price. Clearly, the argument is retain ownership. Let's see why. This ownership lease deal, look at the change in cash flow. We went from, in the first scenario, I'm going to go back to this one. We have $45,000 after-tax cash flow. In this new scenario, we have $59,170, which clearly boosts internal rate of return. There's always the argument as to, oh, we should own the property. No, we shouldn't own it. We should own it. No, we don't. Okay, what's the market demand? 2, if it's an internal deal, should you own? If your company is only earning 12% and your property is earning 14% internal rate of return, that's a clearly obvious answer. But if you have 1,000 offices, 1,000 coffee shops, does it make sense to own? You have to crunch the numbers, and here are the numbers. I'm not going to go through this again. This particular scenario clearly favors ownership, but put yourself into a different situation. Rewrite this. Come up with a hypothetical and change the scenario. I've always been one to state own. Why? Unless you have a return on capital of 18%. Most companies have a return on capital that is at break even, which is about 10%, which points to, well, real estate companies are within that group. Why would it not make sense to own the property? Give me your opinion. I'm a firm believer of ownership. I would work out a strategy or an example where it's advantageous long-term to own the property. But you may have a different philosophy, and let me know what the numbers look like. There's an overview: rent or lease versus ownership, or lease versus ownership. I'm letting you read this on your own because it's pretty much a boilerplate of what I've just talked about. There's a couple tips in here. As I mentioned, if you're a Starbucks, does it make sense to lease or own all of the 10,000 coffee shops? The numbers would make sense. It's all available in the SEC documents. So if you want to crack that open and take a look to see what their leases versus if you put ownership in there, it may make sense. Brad Williams, Frugal Finance. Thanks for watching.